Hi, this is Steve Bohm, and this panel is going to discuss BDCs in general. I'd like to introduce my fellow speakers, all of whom are partners at Eversheds. We have Ann Obendorf, Stephanie Hildebrandt, Kristen Burns, Cindy B.A., Paim Siadatpour, Owen Pinkerton, and last but hardly least, Cynthia Cruz. So why don't we get started, and I'll give a little overview of the BDC industry and how it all started. In the 1970s, late 1970s, there was a push to get more capital into private companies. The 3C1 exemption, which was for companies with fewer than 100 shareholders, did not seem to be adequate to get dollars into venture or other growing private companies. So Congress in 1980 passed the act that created BDCs. Under the act, Congress made sure that this vehicle, while it would be treated under some but not all of the provisions of the 1940 Act, was designed to encourage private investment, public investment in private companies. So therefore, the critical provision is that 70% of a BDC's assets must be in US companies that are domiciled in the US and basically are either private, or eventually it would change to add public companies with less than $250 million equity market float. The BDC model was originally thought to have been perfect for equity raises, equity investments. However, over time, BDCs became almost exclusively debt investors. And really, a BDC is a hybrid between an operating company and an investment company. It's like an investment company because it's subject to most of the 1940 Act requirements that are applicable to registered investment companies. But it's like an operating company because it's regulated under the 1934 Act and has to file Qs and Ks and 8Ks, just like an operating company. So it's very good for the lawyers who get to do a lot of different kinds of work. And it's very good for the public because there's all kinds of disclosure, similar to an operating company with the overlay of regulation of the 40 Act. Cynthia?
Stephen, do you know who pushed for the BDC format or changes in the legislation?
It was the small business industry, specifically the, Cynthia, why don't you tell us?
It was Heiser, and he had a venture fund, and he wasn't able to effectively provide for a carry or provide for leverage. So it was kind of an outgrowth of the small business investment company grouping. Anyway, so it was, he actually went to Congress in order to basically discuss with them how he could change the model. Because if you notice, most of the BDC rules are at the end of the 40 Act, where a lot of people don't venture to go. Anyways, so Steve focused on the format, but just to talk for a minute on the benefits of the BDC model. One of the benefits is it does provide access to the public capital markets, and it allows for the shares to be traded on exchanges. Also, since actually 10 years after the BDC structure came into place, the RIC rules were changed so that you could have pass-through tax treatment. And then there are some reduced burdens under the 40 Act, similar to what I just mentioned, some of the more flexibility around leverage and affiliate transactions. In addition, you can have an external or internal model. The external model allows you to have a management fee and a carry. I believe it actually is one of the only vehicles that allows a performance and allows you to raise money from all levels of the capital structure. And then there's obviously publicly available reporting. And so the BDCs have to value and report their portfolios on a quarterly basis, which is somewhat uncommon. And then a number of the portfolios are also diversified, although it's not required to be. Anyway, so those are some of the benefits of the BDC model.
The BDC industry has developed slowly, but it has caught fire over the last 10 years. Before 2000, there were really only one or two BDCs of size, particularly Allied Capital. Beginning in 2003, the industry started experiencing a large number of IPOs. Most notably, in 2004, Apollo raised $930 million in less than 3 months, which ignited the growth of the externally managed BDC industry. In 2008, Franklin Square formed the first non-traded BDC, which looked a lot like the industry, the non-traded real estate fund industry. And that took off with Franklin Square's success. And in 2011, what was then called TPG launched the first private BDC. The industry has grown substantially since then, and as of June 2021, there were over $160 billion in assets under BDC management. Cynthia, you want to talk a little bit about the structure of the industry today?
I was going to ask you another quiz.
Oh boy. Uh-oh.
So when Apollo was closed, do you know how many BDCs were registered?
I would guess less than 10.
There was about 6. And a week or so after Apollo got closed, do you remember how many there were?
I think there were about 10 or 12 filings within about a year of Apollo. Did I get it close, Cynthia?
You did. It doubled in size overnight. But how many of those got done?
Not a lot. I think probably less than 5.
2.
It's less than 5.
and instead of going on to the and what was the do you know who they are?
Oh, that's a tough one. Was Ares one of them? Or did
Yes,
Ares
it was.
come later? And the other one, I'm going to have to pass. I don't know the answer to that.
Prospect.
Well, and they're both around and they're both doing well. Obviously, Ares is the super BDC given its size, but Prospect has done well as well.
So we've seen it go from a handful of BDCs to over 100. The traded BDCs there's 46 of those, and the market cap is about 51 billion, and the assets are over 100. And then the private BDCs, which we'll discuss also, there's 47 of those, and it's 34 billion in assets. And then there's about 16 non-traded, which we'll also talk through, which is about 25 billion in assets. So Steve, maybe you can talk about some of the other BDCs that are out there, or some of the platforms, or maybe what's changed a little bit in the industry.
Well, what has changed has been the continuing growth of BDCs sponsored by large platforms. Obviously, there are some smaller platforms that are out there, but the large platforms have been getting into the BDC space. And what's interesting, in about the last 9 or 10 years, is there have been very few blind pool IPOs, which was the way BDCs started back in the 2003, 2004 period. What has happened is a lot of the BDCs that have gone public have started as private BDCs, as TPG did, and a number of others. And what has happened is there's a great growth in the formation of private BDCs these days. But what's really interesting about that is, while originally private BDCs were designed as vehicles that would get up to scale and be in a position to do an IPO, there are a number of private BDCs out there today that don't intend to go public, or that is probably the least likely of their liquidity strategies. So we have an interesting industry right now. We have traded BDCs where there are not a ton. We have private BDCs where I think there are about 47. And then we have the public BDCs, some of which came out years ago as blind pool IPOs, and some of which have evolved from private BDCs.
And Steve, on the structures, it seems to me that one thing that continues to happen is the industry keeps reinventing itself. It went from mostly everybody was familiar with the traded structures, but when folks tried to get in, they didn't have a platform to effectively provide the yield, which is a lot what people are looking for. So most of the BDCs are debt. There's been very few that have been equity. So then folks looked for another structure, and they looked to the model of the non-traded REITs, and that was another channel that they could that BDCs could raise money into. And that's the one issue on theirs is the distribution, and Owen will go into that. When the non-traded structures became more prevalent, people started looking at whether there was an ability to do a private BDC. And one of the things that's changed with the private BDCs, which is where a lion's share of the money has been raised recently, is that everybody thought that those needed to be have a shorter life, and similar to the non-traded structures. But more recently, a number of those have come out that are permanent life vehicles. So there's a lot of change and restructuring, and one of the things I can say is that there's a lot of resilience in the industry, even through a variety of cycles that we've been through. The BDCs always find a way through to basically raise money and put money to work for mainstream America.
No, I think you said it exactly right. Resiliency. There was in 2008, BDC suffered the same fate as many financial institutions, and that is there was a real slowdown. IPOs became less prevalent, and frankly, no pun intended, Franklin Square, it reinvented the BDC industry at that time by going out with a non-traded product that didn't depend on the vagaries of the market for success. It was meant as an illiquid vehicle, although eventually it IPO'd. It was meant as an illiquid vehicle with a steady, where the value would be based solely on NAV and not on market prices, which made it an attractive vehicle, especially it was aimed at the purely retail investor. And of course, the private BDC came out in 2011. So it's been an evolving universe of BDCs. We see BDCs that are specialty investors in senior credit like Solar has and like others have. We have BDCs that have a little bit more of an equity component, and I think we'll see a little bit more of that. And we have other BDCs. So one recently came out that focused on cannabis, which cleared the SEC. And so it's a really interesting industry right now, and who knows what's coming next.
Well,
So
let's go into a little more detail on each one of these. Steve, do you want to?
Yeah. Let's talk about traded BDCs a little bit. Pime, you want to describe how they operate today?
Sure. So traded BDCs are typically formed by conducting an initial public offering. And the BDC will either operate as a blind pool and seek to deploy the IPO proceeds, or the IPO proceeds will be used to acquire an existing portfolio of assets. Obviously, they're traded on an exchange, either the New York Stock Exchange or the NASDAQ, and they'll have an indefinite term. So now I'll talk a little bit about the IPO process for traded BDCs. Typically, it'll take anywhere from 6 to 8 months to complete an IPO, and there are a lot of moving parts to think about during that time. And the best way to ensure a smooth process is to plan and prepare for each of those steps as early as possible in the process. And I'll just list a few of those items to think about. So first, formation and structuring issues. And this is particularly relevant if the IPO proceeds are going to be used to acquire an existing portfolio of assets. Considering any necessary exemptive relief, for example, if the BDC will want to co-invest with other funds on the advisor's platform once it's operational, preparing the registration of the investment advisors, registering the investment advisor, assuming it's an externally managed BDC, in which case the advisor will need to be registered under the Investment Advisors Act, developing compliance and corporate governance programs applicable to BDCs, identifying potential nominees to serve on the board of directors that are independent of the advisor. BDC's board must be comprised of a majority of independent directors, and these individuals will need to satisfy the independent standards of not only the 1940 Act, but also those of the applicable exchange. And lastly, selecting the various service providers of the BDC. And this includes picking the lead underwriter for the IPO, a registered public accounting firm, independent valuation firms, a custodian, and a transfer agent, to just name a few. Now, to complete an IPO, BDCs must file a registration statement on Form N2. And the registration statement will include disclosure about the company, its business, and of course the terms of the offering, along with all the various disclosure items required by Form N2, and there's quite a bit of them. Once the Form N2 is filed, obviously that document is public, and the market will know that the BDC is contemplating an IPO. But an alternative under the Jobs Act exists for BDCs that are a little bit wary of market risk of being out there publicly. You can submit your registration statement on a confidential basis, so that obviously, if for whatever reason the BDC decides that it does not want to conduct the offering, there'll be no public record of ever having submitted an N2 with the SEC. But bear in mind that if you do choose to go the route of a confidential submission, that document still needs to be substantially complete. In some respects, it is less onerous than filing publicly. You don't have to name an underwriter, for example. You don't have to have an auditor's consent, nor do you have to have the registration statement executed by officers or directors, because it's not technically a filing. But it does need to be a serious document for the SEC to basically agree to review it. In fact, your first submission you make, you will get comments, but if by the second submission you haven't identified and disclosed an underwriter, the SEC typically will not continue the comment process. Now, once you do file the Form N2 or confidentially submit it, the SEC review period begins. The SEC generally takes 30 days to provide the first set of comments, and you should expect about probably maybe 2 or 3 rounds of comments before the SEC will be ready to declare the registration statement effective. During that time, you'll need to apply to have the BDC securities listed on an exchange, again, either the NASDAQ or the New York Stock Exchange. You'll need to register a class of securities under the Securities Exchange Act. And once you're towards the end of the review process, you'll file a form called an N54A, which is the election to be regulated as a BDC. And at that point, you'll have the SEC declare the registration statement effective, and then the BDC can conduct its offering. And obviously, after the initial public offering is complete, the BDC is operational, and it has to comply with all the various 40 Act requirements and the 1934 Act requirements, such as filing 10Qs, 10Ks, and Form 8Ks, among other filings.
Thank you, Payam. And can you keep going, if you will? Talk a little bit about the requirements under the NASDAQ and NYSE listing standards for BDCs. And I think there have been some recent initiatives that are worth discussing.
Sure. So following the completion of the IPO, because a traded BDC is obviously listed on an exchange, they have to comply with various corporate governance standards of either the NASDAQ or the New York Stock Exchange, again, depending on which one you choose. There's a fair bit of overlap between them, and I'll just list a few. So both the New York Stock Exchange and the NASDAQ require listed companies to have an audit committee and a compensation committee that's comprised solely of independent directors, and there must be at least 3 members on such committees. The New York Stock Exchange also requires a nominating and corporate governance committee, but the NASDAQ provides the option of not having a separate nominating committee, but just to have the majority of the independent directors elect members to the board. Although most of our clients that are NASDAQ listed, they do end up having a separate nominating committee as well. In addition to that, listed companies on both exchanges must adopt the Code of Business Conduct and Ethics, and also various committee charters, and all those documents need to be posted on the company's website. And lastly, I'll mention, Steve, you mentioned the recent initiative. The SEC recently voted to approve new listing rules proposed by NASDAQ that are designed to enhance diversity on the board of directors of NASDAQ listed companies. In summary, companies listed on the NASDAQ, subject to certain exceptions, will be required to annually disclose the statistical information about its board diversity, and to either add a diverse member to their board of directors or disclose why they've chosen not to. And those compliance periods begin, as it relates to the disclosure related component of the rule, it begins in 2022, and the compliance period for the actual board membership requirements begin in 2023. So that's a general overview of traded BDCs and the listing standards that go with being a traded BDC. I'll turn it over to Cynthia now.
Thank you,
Great.
Brian.
And, we talked a little bit at the outset in the overview about the non-traded structure, where effectively there was a development from the listed to the non-traded to reflect the somewhat the non-traded REITs. Maybe you can, Owen, talk a little bit about what some of those features are, or differentiate how they different, or how they're different from the traded. Sorry.
Sure. Thanks, Cynthia. So in summary, I guess a non-traded BDC basically often is it's generally a blind pool offering, continuous offering to retail investors. So it's you file a registration statement, you have registered securities, and they offer the securities continuously to retail investors. And so the difference, obviously, as the name would suggest, is that the securities are not traded on an exchange. Sometimes they eventually will become traded vehicles, but the intention, at least in the beginning, is that at least during the initial fundraising, that there won't be any, that the securities will not be traded, and that if they are, it's probably 5 to 7 years or some period of time after the offering ends before that happens. As has been mentioned, the non-traded BDC structure was modeled after the non-traded REIT structure. And so a lot of REIT sponsors and others that had experience in that industry were looking for an alternative yield product that, in addition to, one of the benefits of the non-traded REIT model was that investors were investing directly into real estate. They weren't investing in the public market. So in other words, the properties that were held by the REIT is more of a direct investment in those properties themselves. and the value of the REIT was not necessarily subject to any sort of market pressures or anything else. And so the non-traded BDC has the same sort of structure with respect to private credit. And so it's an opportunity for retail investors to obtain yield through an investment in private credit that in many ways wasn't available to them earlier. The only way you could really be involved, that you could get an exposure to private credit, was through a registered fund, whether it was an ETF or a mutual fund. And then oftentimes it was much more indirect, because they have liquidity standards that they have to abide by that you don't have with the BDC. So the general structure is that you've got a sponsor, or this is historically how it's operated, not required to be this way, but this is how it's done, is you have a sponsor that either has an advisory background or a distribution background, and if they have an affiliated broker dealer, then they can do it all under the same umbrella. In other words, they can do the advisory work and distribute the securities all under the same umbrella. The affiliated broker dealer would have relationships with a number of independent broker dealer firms, and they would have agreements with them in order to sell securities broadly. Oftentimes, if there is no affiliated broker dealer structure, then you would have an advisor and a separate broker dealer, and they would essentially do a joint venture where one of the parties agrees to also handle back office administration work, things like that. There are a limited number of broker dealers that really have a strong network of independent broker dealer channels. So you can imagine that, where most of these firms started was from the REIT model, because they already had those established relationships. Establishing a new broker dealer for the non-traded space is a very, very costly and time-consuming process, and most people don't want to go down that road. In the initial years, the initial BDCs that came out largely focused on just the independent broker-dealer network and selling shares through that channel. They wanted to sell more through the registered investment advisors, but they didn't have a lot of luck initially. I think that's changed in recent years. There's been much more penetration of the RIA market than there was before, and we've even seen some penetration with the wirehouses, which didn't happen at all in the beginning. So there's been a lot more market acceptance. There are far fewer non-traded BDCs that are out there right now that are raising capital, but the ones that are doing so successfully and through different distribution channels than what we saw initially. So go ahead.
And one of the things that's changed also is the multi-class structure and the exemptive relief that wasn't available initially. And then maybe you can mention the issue around state registration, which REITs don't have to deal with, or it's a little bit of a headache for BDCs. Yeah.
So some of the characters, and there are a couple of things that are completely different for non-traded BDCs that others don't have to worry about or deal with. One is, Cynthia mentioned the state blue sky requirement. So because BDCs are not registered investment companies, you elect to be regulated as a BDC, but they're not registered investment companies. The consequence of that is that the securities that are issued by BDCs are not covered securities under NISBA, and therefore they are subject to full state qualification. In other words, you don't have to just make notice filings with the states. You have to actually register the offering in every state in which you offer shares, which is an enormous headache. And I guess to Steve's point earlier, it's good for the lawyers, I guess, but it's an enormous headache. It can also be pretty costly. I mean, all the states have registration fees in addition to any time spent trying to get through the states. There are a number of states that will also issue comments, and so what they mostly look at is the governing documents of the BDC. They're not as interested in the disclosure. They want to make sure that everything that you can cram into the charter, you cram into the charter so that it can only be changed by stockholder approval. And that's really the goal. The requirements are mirrored after there are NASA omnibus guidelines that were initially drafted for limited partnerships, but those have been adapted to some extent to cover BDCs. And then eventually, supposedly, there will be BDC guidelines, but we don't know when. Another thing that is unique to this kind of a structure is that the registration statement is an ongoing registration statement. You have an evergreen prospectus that needs to be updated constantly because you're always offering shares, you're always in registration. So there are numbers. Anytime there's anything that happens on this material has to be supplemented. So in addition to any 8K requirements and 10K, 10Qs, you're also filing supplements on a regular basis. And you have to be wary of the fact that you're always an offering. And so therefore, you have to be careful about what you say. There are different ways where you can file different material with the SEC as advertising material to get around that. But there are communication issues that you don't have when you're not constantly an offering. And then lastly, the FINRA, obviously these are subject to FINRA review as well. Non-traded BDCs are considered to be direct participation programs, which puts them under FINRA Rule 2310. And in a nutshell, that just means there's a 10% cap on underwriting compensation, and that includes non-cash compensation, cash compensation, all in from all sources, which can get very complicated and is also a time-consuming process. So I guess so in light of all that, you might think, well, why would you ever want to do one of these? and there are a couple of reasons why it's really, it is a product that is worthwhile in a lot of respects. It gives you access to retail investors that you wouldn't have under the competing models. I mean, if you compare it to interval funds or closed-end, tender offer closed-end funds, they generally are going to be, through a platform, whether it be Schwab or TD Ameritrade or something like that. Whereas non-traded BDCs can go directly to the retail investors. If you have the broker-dealer network to be able to access those investors, it's a huge advantage. For investors, it's an opportunity to invest in a new entity at the outset rather than waiting for the entity to mature and then investing once it's already mature. So you get the opportunity of being an early entrant. It's continuous capital raise, so you have money coming in on a regular basis, and you've got a lot of flexibility with respect to repurchases. On the flip side, in addition to Blue Sky and FINRA and the expenses are associated with those, non-traded BDCs are required to have subscription agreements that are that will include state-specific suitability requirements and other things in there that really are not very attractive to RIAs and a lot of investors. It's a long document, and everyone likes filling those things out. And that can be a big differentiator when you're talking about interval funds where you can get a ticker symbol, for example. And also, cash drag. I mentioned continuously raising capital, which is a beneficial thing, but on the flip side, unless you're able to deploy that capital quickly and effectively, you're always going to have some cash in your balance sheet, which you may not want to have. And that's not necessarily true of some of the other structures. Cynthia also mentioned the multiple share classes, and there are a couple of recent regulatory changes that are really beneficial to non-traded BDCs. One of them is that finally BDCs are able to issue multiple share classes. And this is something that non-traded REITs have always done, and they didn't have to get any sort of exemptive relief or anything else. So this really puts BDCs on parity with non-traded BDC, with non-traded REITs, but also with other structures like interval funds. Increased leverage compared to other products just by being a BDC. And also recently being able to update prospectuses do your annual updates through Rule 486, which had only been available for interval funds. It allows you to update your registration statement without SEC review, and you get to pick when you go effective, which is a huge advantage. And for somebody who went through the process a number of times trying to meet the timeline of getting effective before April 30th was a welcome change.
So just to mention that I think Steve talked about some of the IPOs you can do in a couple of months, 3 to 4 months, but non-traded, you are talking about a fairly lengthy time. You may go effective before you likely will go effective before you raise much money. And then it could take up to almost a year to get it kind of up and running to have a core amount of a portfolio. So it's a process, I think is what we're trying to describe. So
yeah, and you may get clearance from a number of states, and there may be some that you don't even hear from for the first 6 to 9 months. But for the most part, you can get a good threshold of states within 6 months, but it'll take a long time. It doesn't happen overnight, that's for sure.
Oh, and it seems that the non-traded space has not grown as fast as certainly as fast as the private BDC space. Is that attributable to the difficulty in finding distribution, or is it something else?
I think that's one aspect, because it's a very specific distribution network. It's not like the distributors you have for registered fund products. They actually, in order to be a dealer manager in a BDC offering, you actually have to do some work. You have to actually have all these networks. You can't just be a distributor on the front cover and introduced to platforms. So a lot of distributors don't have this capability. They just don't have the ability to do this. But part of it is, I think the subscription agreements and the suitability requirements and those aspects that you don't have for a interval fund or a tender offer closed-end fund, I think have hurt BDCs on the non-traded side. And up until recently, not being able to issue multiple share classes was a big issue as well.
Oh, and we've talked about traded BDCs. Of course, we just talked about non-traded BDCs. Now we'll come to the fastest growing area of this sector, and that is private BDCs. Kristen, can you tell us the advantages of private BDCs and the main differences between them and the other two types of BDCs?
Sure. The main differences between a private BDC and a non-traded or traded BDC is really the manner in which it's offered and the class of investors to which it is offered. So it's done pursuant to an exemption from 1933 Act registration, which is usually Regulation D, and it's offered to, the offering is limited to accredited investors. Because it's not a registered offering, the offering is made pursuant to a PPM. You do have to file a more fulsome registration statement under the Exchange Act. So instead of a Form 8A, which a traded or a non-traded BDC would file, you file a Form 10, which just contains additional information. And that is necessary to make the BDC election. In order to elect to be a BDC, you have to have a class of securities registered under the Exchange Act. One of the main differences generally between the private BDCs and the other structures is that it's done pursuant to a capital call structure. So the investor enters into a subscription agreement with the private BDC, and they agree to fund up to a certain amount of money as it's called. And this eliminates the cash drag that Owen mentioned. The BDC doesn't have to call the cash or have it on its balance sheet until it's prepared to make investments. Generally, there's no liquidity or trading in these in private BDCs. Sometimes the private BDC will make periodic repurchase or self-tender offers, and there's usually some ability to transfer to a different accredited investor with the consent of the BDC, but there's no trading market. So the investor needs to be committed to the investment for the life of the product, which is usually 5 to 7 years. And after that period of time, the BDC agrees to either wind down or to undergo a liquidity event, which could be an IPO or a merger into a traded product. In terms of advantages, I think the main advantage is the capital call structure, which I mentioned. It eliminates the cash drag and really allows the BDC to manage the amount of cash on its books, and also the optionality. You don't have to determine what your end result or liquidity event is at the outset. You can give the board discretion to use their best judgment based on market conditions at the time. And you can also structure it so that maybe there's a different management fee while the company is private, which will automatically increase following a listing, an exchange listing. And it's also a shorter process. A Form 10 will be automatically declared effective in 60 days, and there's no negotiations with a stock exchange. And Owen mentioned some of the more onerous state filings in connection with a non-traded product, and because this is a private placement, you don't have that here. I think the private BDCs often get compared to private funds, and there are some tax advantages to foreign investors between a private BDC and a private fund.
So we've talked mostly about the capital raising piece of the BDC, but there actually are other pieces that go along, and we're going to turn to those next. And so Stephanie and Ann, I'll walk through some of those requirements. Maybe you can talk, Stephanie, a little bit about the reporting requirements and the financial statement disclosures that are required, since this is a reporting entity, which we try and emphasize to people. And that's from the kind of the get-go once you decide to be a BDC.
Sure, yeah, and Payam alluded to some of this when he was speaking earlier, and this applies to all BDCs, whether it be a traded, non-traded, or a private BDC. Each BDCs are by definition public reporting companies, which means that they are required to file Form 10Ks, which is your annual report. It includes a more fulsome business section. It also incorporates certain sections from your proxy statement, including disclosure about the management teams, and if it's an internally managed BDC, executive compensation. On a quarterly basis, the BDCs are filing a Form 10Q, which doesn't have the extensive disclosure of an annual report, but is really focused on the quarterly financial statements and the MD&A for the quarter, the discussion of those financial statements. BDCs are required to file Form 8Ks for current events. There's a long laundry list of events that require a current report on Form 8K to be filed, or a periodic report, it's also often called, including entering into a material definitive agreement, so your credit facilities, a strategic transaction, those often get pulled in as material agreements. Any changes in your executive C-suite officers, also changes in directors are required to be reported. Issuances of unregistered securities. So for example, in the private BDC context where funds are being raised privately and they're not registered with the SEC, every time you do a capital call and issue those securities, Form 8K is required. BDCs are required to file proxy statements and follow the proxy rules with respect to annual and special meetings of shareholders. BDCs are really their directors and officers and certain shareholders are required, just like any other public company, to report beneficial ownership. And all BDCs in their disclosure generally must comply with regulation FD, which goes to fair disclosure and making sure that current information is out there about the BDC, as well as Sarbanes-Oxley and the company's internal disclosure controls and procedures. So for the 10Ks and 10Qs that include financial statements, the 10Ks include audited financial statements. Your 10Qs are unaudited, but also reviewed still by the company's auditors. They include your typical balance sheet, income statement, cash flow statement. But what is often considered one of the more important pieces of the financial statements is the schedule of investments. The schedule of investments lists each company's investments fair value that's determined on a quarterly basis by the board. The fair value hierarchy is involved, which is your level 1, 2, or 3 investments. Most BDCs investments qualify as level 3 because they are highly illiquid as compared to a level 1 investment, which is very liquid. BDCs also have to present control investments in affiliates, investments in non-affiliates, and break out into separate categories. And then the schedule of investments itself includes more detail about each investment, including the portfolio company's name, the interest rate, the maturity date, and just terms generally, cost basis versus fair value basis of the investment. So again, that's very high level. There's a lot of detail there, but we won't do that for this call or this.
Right. Well, and one of the benefits these days is recently the SEC did put in place new rules that allowed you to incorporate by reference those materials similar to other operating companies. But we can go into that in more detail another time. One of the areas that people focus the most on is that there is restrictions on the type of investments you can make. And the SEC did allow certain flexibility in the 40 Act, but as a result of that required certain type of investing. And maybe you can talk about what a qualifying asset is and the 70%, 30% tests.
Sure, and I think Steve mentioned this earlier, but a qualifying asset is defined in Section 55A of the 1940 Act, and it includes securities issued by an eligible portfolio company. An eligible portfolio company is generally, as Steve mentioned, it's a U.S. company that is not an investment company or is not excluded by from the definition of an investment company in Section 3C. And it either doesn't have its securities listed on an exchange, or if its securities are listed on an exchange, then its market cap is less than 250 million. So as long as a BDC has at least 70% of its assets invested in these qualifying assets, the other 30% can be invested in other types of assets.
And we spend quite a bit looking at those types of, on whether something qualifies or doesn't qualify, right? Because so you have to have 70%, which you wouldn't have to do in any other kind of closed-end fund in those eligible portfolio, and you have to also provide or offer managerial assistance. What can go in the 30% bucket?
Foreign investments, for example, investments in foreign companies.
So anything that doesn't fall in the 70%.
Right, anything else.
And then another limitation or something you have to be cognizant of is the affiliate transactions, which you've got several different flavors. You've got close affiliates, remote affiliates, and then non-affiliates. And maybe you can just talk a little bit about that structure and how to satisfy it.
Sure. So Section 57 of the 1940 Act discusses transactions with affiliates. There are 4 types of transactions with affiliates. Those include a BDC selling securities to an affiliate, a BDC purchasing securities from an affiliate borrowing from a BDC, and a BDC participating in a joint transaction with an affiliate. And joint transaction is not really defined, but the most common example would be a co-investment transaction, which is a very common joint transaction. That is when a BDC invests in a portfolio company with an affiliate. And whether a BDC can participate in an affiliate transaction depends, as you mentioned, Cynthia, on the nature of the affiliation. So if there's no affiliation, then obviously there's no prohibitions based on affiliations. There may still be other reasons why the transaction cannot be completed. We'll talk about some of those later on, I think. But if it's a remote affiliate is defined in Section 57E. It's a list, a long list, but for example, a 5% shareholder of the BDC would be a remote affiliate. If the transaction involves the BDC and a remote affiliate, it can be completed with the approval of a required majority based on the requirements in Section 57F. And then a close affiliate is defined in Section 57B, and that includes, for example, the BDC's investment advisor or a company under common control with the BDC. If a close affiliate is involved in a transaction, the only way the transaction can be completed is if the BDC and the affiliate apply for an exemptive order from the SEC and receive the exemptive order to do the transaction. The most common example of obtaining an exemptive order would be a co-investment exemptive order. That's a very common type of order granted, and many BDCs in the industry have such an order, which allows them to co-invest with certain of their affiliates subject to the conditions in that order. There are some exceptions to the restrictions I just went over. For example, if a BDC and its affiliate invest in a transaction and the only term of the transaction negotiated is price, then they can do that transaction without obtaining an exemptive order because they can rely on the mass mutual no action letters. Those letters state that if the only term negotiated in a transaction is price, then that transaction is not a joint transaction.
Right. And you and Steve did a whole presentation. If anybody wants to hear in more detail what it takes to do a co-investment and how to comply with the any conditions, right?
Right. I'm keeping it short today, but I can talk for a long time about it.
Yeah, Anne is probably the goddess of co-investment. She probably knows more about this than anyone. Anne's worked on probably close to 40 of these applications. I'm not sure when Anne was in law school, she dreamed of having that title, but it's something that has evolved for her. So we strongly recommend seeking out Anne for difficult questions on co-investment.
Right.
Thank you.
So even though now we've talked about reporting, we've talked about the investment portfolio, there still are other requirements because you're regulated under the 40 Act, similar to a mutual fund. What are some of the other types of things that a BDC would have to put in place in order to meet those compliance requirements?
Right. There are a number of requirements. For example, the board of the BDC must be comprised of persons who are not an interested person of the BDC as defined in section 219, which basically means that they can't have any connection with the BDC, no material business relationship, etc. A BDC must maintain its securities and other assets in custody in compliance with the 1940 Act. And typically most BDCs hold their assets in the custody with a bank, but there are other options. A BDC must maintain a bond, a fidelity bond, issued by a reputable fidelity insurance company, which protects the BDC from larceny and embezzlement. The fidelity bond has to be in a specific amount, which is set forth in the 1940 Act based on the BDC's gross assets. And a BDC must maintain and enforce a code of ethics that, among other things, requires reporting of securities holdings and transactions of the directors and officers of the BDC.
So in addition to those, there's restrictions about basically pyramiding BDC investment companies on top of each other. So there's restrictions for ownership levels above and below. Maybe you could describe those a little bit.
Sure, and I think the theme of this section is restrictions. A BDC may not acquire more than 3% of the outstanding voting stock of a registered investment company or another BDC. And a BDC may not invest more than 5% of the value of its total assets in a registered investment company or another BDC. And a BDC may not invest more than 10% of its total assets in registered investment companies or other BDCs in the aggregate. So it's a couple things to keep track of. And then it works the opposite way, that a registered investment company or BDC or a company that is accepted from the definition of investment company under section 3C1 or 3C7, none of those entities can own more than 3% of the outstanding stock of a BDC. Lastly, on this issue, a BDC can own shares of a 3C1 or 3C7 fund, but only up to 15% of the BDC's total assets. That is per an informal SEC guidance.
So, how does the BDC keep track of all of this? Are they required to have a compliance program or a chief compliance officer?
They call Ann.
Yes, there are many compliance requirements for a BDC, as you just referred to, Cynthia. A BDC must appoint a chief compliance officer and must maintain a compliance program that is overseen by that chief compliance officer. And that program should be designed to prevent violations of the federal securities laws. The investment advisor of the BDC is also required to implement policies and procedures designed to prevent violations of the federal securities laws, and which include many policies, including a code of ethics. And then BDCs and their investment advisors are also generally subject to examinations by the SEC.
Great, and then maybe you can just run through a couple other things that come up every once in a while, trading below NAV, leverage ratios, those kinds of things.
Sure. Yeah, I'll start with noting that BDCs generally cannot sell their shares below their net asset value without board approval or shareholder approval. To the extent the BDC wants to sell shares below NAV, they would need to get shareholder approval at an annual or special meeting. And that shareholder approval, it's not a standard majority vote, but it's what we refer to as the 40 Act majority. So it is a higher standard to get that approved. And also, you know, over time, the market is limited what BDCs can sell or what they can get approved by shareholders to sell when selling below NAV. And for example, they limit some BDCs in their proposals limit the percentage of these sales based on the company's outstanding shares or based on how many shares are sold generally. And I think Anna already alluded to the exemptive relief for co-investment transactions, but there are a number of other requirements. You know, Cynthia mentioned leverage. You know, I think as everybody knows recently, the SEC reduced the asset coverage requirement, which essentially allowed BDCs to be able to lever up more than they had been in the past. And that again also requires board approval and shareholder approval. If it's just approved by the board, the approval to use the increased leverage becomes effective a year after the board approval. If a BDC gets shareholder approval, it's effective immediately. So different BDCs, I think when these rules were just first passed, took different approaches. You know, a lot of BDCs started the clock ticking with the board approval, only to follow with shareholder approval to get take advantage of the increased leverage quicker. New also are able to basically use the higher leverage out of the box. In that regard, you know, rather than waiting until you have, you know, hundreds of shareholders, you have one shareholder. When first formed, you get that sole shareholder approval, and you're able to rely on and use the increased leverage out of the box.
Great. And we also talked a little bit about the reform rules and some of the things that have been put in place. I don't know if you want to comment on that at all.
Sure, yeah, and I think this was mentioned, I think, by both Owen and Pime as well, and what they were talking about, that basically with the offering reform process, it allows BDCs to be treated like other public operating companies. They're able to incorporate by reference, so rather than having to go through an extensive review process for a shelf registration statement annually, you're able to use, and BDCs are able to just rely on and incorporate by reference their financial statements for both year end and quarter end. They're also able to, for the larger BDCs, qualify as a WIC-C, which allows for immediate effectiveness and even much less SEC review. And they're also able to use I guess, lesser stringent communication and prospectus delivery requirements. Again, all consistent with how operating companies have been treated over the years, and BDCs are just now catching up.
Great. And then just, we talked a little bit about governance when Payam spoke about the NASDAQ and New York Stock Exchange. And what are maybe the top three primary requirements for a BDC board, if you just had to summarize them?
I would say independence, independence, independence. That's really, that comes both out of the 40 Act as well as the listing standards. And, you know, I think we've talked about this already about, you know, no material relationship, but there are tail periods there as well. So, you know, just because a director who is also an officer resigns from being an officer doesn't make them automatically independent or automatically not interested. There's a 2-year look back period. If directors are entering into some sort of lending relationship with the BDC, there's a tail period there also. Any material relationship at all, if it's material to the individual, they are not going to be independent. If they're familial relationships, they are not going to be independent. And I think we also talked about the code of business conduct. and ethics. And here, there are really two codes for a BDC. There's your standard Sarbanes-Oxley code that is required as a public company, but then the 40 Act also requires companies to have a code of ethics. So those policies often go hand in hand, but they are two separate requirements. Again, one coming out of the SEC and the listing requirements, and the other coming out of the 40 Act requirement. And we also talked, I think Pam also referred to this, you know, NASDAQ and the SEC have just approved diversity requirements for board composition. We're also doing a presentation on that as well. So tune into that. But that is coming down the pike. And in 2022, there will be the diversity requirements.
Great. And so we've got an independent board. They've got to value the portfolio and they have to implement the compliance. Now we're ready to operate. Steve?
That's a great segue. And this is really a practical discussion of what you have to do to make this thing operate and make the trains run on time. Cindy, you want to talk a little bit about how BDCs operate? Most notably, why don't we begin with a comparison of internally managed BDCs, which is where the industry really started, and externally managed BDCs, which is where the vast majority of BDCs are today.
Sure, thanks, Steve. So I think a lot of what we've talked about today is how BDCs have characteristics of operating companies and how they also have characteristics of registered investment companies. And this sort of distinction and dichotomy is definitely applicable here. An internally managed BDC is really a BDC that has employees that manage its investments. In the same way, really, that you think of as any operating company. The BDC pays salaries to those individuals, and they must comply with SEC executive compensation disclosure, again, like operating companies. I think one distinction is, unlike operating companies, because of the restrictions in the 40 Act, there are restrictions on the type of compensation that you can pay your executives who are employees of the BDC. Specifically, because the 40 Act restricts the ability of a BDC to issue its shares in return for services. Most compensation that you would need to pay for your officers and executives needs to be in cash. However, a number of BDCs have obtained exemptive relief to be able to issue restricted stock to their employees and officers. And that provides the relief from the provisions of the 40 Act that would make that difficult, including both the restriction on the ability to issue shares for services and also on the ability to issue shares below NAV. Turning then to the external structure, this is, I think you think of this more in the sense of a traditional investment companies. The vast majority of other investment companies, of registered investment companies out there, have external managers, meaning the fund operates as an entity, but it hires an investment advisor, which is a registered investment advisor under the Investment Advisors Act, to manage the assets. So in that sense, it's external because those are not employees of the BDC, they're employees of the registered investment advisor. Under this structure, the advisor is typically paid an advisory fee, a base management fee, which is usually expressed as a percentage of assets. Unique to BDCs of other registered investment companies, or of registered investment companies, BDCs can take incentive fees or can pay their advisors incentive fees on not only just income, but also on capital gains. So a registered closed-end fund, for example, cannot pay its advisor an incentive fee on capital gains. And again, sort of making the analogy to what we were talking about earlier, the advisor is paid in cash out of the assets of the BDC, generally because the BDC can't issue shares in return for service. That being said, again, another compare and contrast that we've been doing throughout this panel, talking about how a lot of BDCs have tried to model things that REITs and especially non-traded REITs have done. There is an exemptive application that's currently outstanding. The relief hasn't been granted yet, but a BDC is requesting relief to be able to pay its investment advisor in shares of stock of the BDC rather than in cash, which is something that we have seen in the REIT world. So.
One issue that's very important, I think, to the BDC industry and to the investment company industry as a whole is valuation. I know in my experience, it's always been a thorny issue, particularly 10 or 15 years ago, when the SEC was really focusing for the first time on the valuation practices of BDCs. There was some public announcements related to that, and a practice has developed today. You want to talk a little bit about that?
Sure. Valuation, I mean, we could do a whole day on valuation, honestly, so I'll keep this brief. But in general, under the Investment Company Act, a BDC needs to, if its holdings don't have a market value, the investments of a BDC need to be determined in the fair value needs to be determined in good faith by the board of directors. So I'll get to that in a second. And given the nature, I think we mentioned this earlier, but given the nature of the assets in which BDCs invest, I'd say most, in some cases, all assets are fair valued, but in most cases, at least a substantial majority of a BDC's assets are going to need to be fair valued because they won't have a market value. And so that one piece that I mentioned, in good faith by the board of directors, has always been sort of a difficult aspect of valuation under the 40 Act because, there's a long process, and often, the board will have expertise, but it certainly doesn't necessarily have all the expertise and knowledge that it needs to value the assets of a BDC. Some, I guess you'd call maybe relief or guidance has come recently in the form of new Rule 2A5, which we mentioned briefly earlier. It's the valuation rule/guidance that has been a long time coming. I think the industry has been waiting for something along these lines for quite some time. It actually became effective on March 8th of this year, but it actually includes an 18-month transition period. So all BDCs will need to comply with this new guidance and under the rule by September 8th of next year. So almost a year from the day that you may be watching this. But and this, it's a long rule. There's a lot that's required of it. Just to sort of cut to the chase of what's important, something that's very important about this rule is that it allows a BDC to designate, and that's the term used under the rule, to its advisor the fair valuation of the holdings of the BDC. There are conditions to that, of course, and there must be reporting to the board, et cetera. And there are a number of requirements in terms of managing the risk and assessing the risk and fair value, including in conflicts of interest, testing the fair valuation methodologies that are used, and also overseeing and evaluating any pricing services used. So, I know that sounds like a lot, but probably at the end of the day, most BDCs are, other than adopting different policies and procedures, for the day-to-day operations of how valuation happens, it's probably not going to change all that much. Most BDCs or a lot of BDCs do use pricing services in order to provide some, non-conflicted advice or guidance on the values of the securities. And so that will certainly continue. There'll just have to be formal policies and procedures in place, to assess those entities. So I think this is definitely welcome relief for boards. The ability to formally designate, I think, is something that, it should provide some comfort to boards. But at the end of the day, I think there's not going to be a ton of change in how this is done.
So it'll continue to be, Cindy, a question of process. And is it fair to say that if boards and nowadays the advisors follow processes that are designed to comply with the Act, they're not going to be held liable if the valuation turns out to be incorrect, because they're not supposed to be predictors of the future. Is that fair?
One would hope that that's fair, but yes, process and policies and procedures and appropriate investigation of things that maybe seem, not right. I think where we've seen enforcement actions in the past, and there haven't been all that many of them, but it has come at times of extreme market turmoil and a board allowing valuation to continue. And that, I don't think we've seen any of those in the BDC space, but have in the mutual fund space, which is obviously a much more difficult task because those funds are doing daily valuation, whereas BDCs are luckily not subject to that requirement.
Right. Lastly, could you talk a little bit about how the tax requirements impact BDCs? Cindy, you don't practice as a tax lawyer, but I think we're all familiar with the general requirements because they're so integral to how BDCs work and why people use BDCs. Can you give us a little bit of an overview?
Sure. So again, going back to what I started with, and I think Cynthia mentioned this earlier, but a BDC is able to be taxed in the exact same way as a registered investment company. The term under the Internal Revenue Code is a RIC, which is not a registered investment company, but a regulated investment company, not to confuse anyone. And it is pass-through taxation, meaning that, you know, again, assuming you comply with the requirements, you're not taxed. The BDC doesn't pay taxes itself. Investors in the BDC would pay taxes on you know, the amounts that are distributed to them. In order to do this, though, a BDC does need to distribute at least 90% of its investment income annually, and 98% of it to avoid excise tax. So it really can't hold on to income to grow. It needs to distribute that rather than keeping it. And then an additional requirement is that 90% of the income that a BDC does receive must be what's called under the tax code as good RIC income. And that's really, you know, income from interest, dividends, and capital gains. So for example, I'll go back to the REIT analogy, but for a RIC, you know, it's difficult for a RIC to hold real estate directly because the income from rent would not, or the rent income that an entity receives from holding a property would not be good RIC income. So that's, again, that's not really, that structure doesn't work for a BDC. And then there's also a quarterly diversification test, which again is getting at the idea that anything that wants to be taxed as an investment company should have its assets sort of well diversified. And there's a couple of tests here. One is that for 50% of a RIC's assets, it needs to be invested in cash, government securities, other RICs, and then, you know, other securities, and any of those other securities can't comprise more than 5% of the BDC's assets. So again, a way of making sure that the BDC has its, you know, is investing in a number of different things. And then there's also a restriction that no more than 25% of the RIC's assets can be invested in any one issuer. So there is a bucket to have a more substantial investment there. And then there's another additional requirement about qualified publicly traded partnerships and limiting those investments to 25%. But that's for a little more complicated than we want to get into here. That's sort of the nuts and bolts of BDC and RIC taxation.
Thank you, Cindy. I guess the good news is, as complicated as the diversification requirements might sound, you only have to comply 4 days a year. Is that right?
The quarterly test is yes, it is a quarterly test, and then there's the distributing your income, which has to happen by the end of the year. So 4 times a year, and then the additional, you know, once a year test.
Well, I think that's all we have for today. I think we covered a lot of ground. I want to thank all of my colleagues very much for their participation, and I want to thank the listening audience for staying with us. I know some of this is complex. So on behalf of my friends on your video screens, thank you very much, and enjoy the rest of your day.